Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway, brought to you by Paramount Residential Mortgage Group.
Welcome to another edition of Master of the Markets. I'm Dan Habib from MBS Highway. This is provided exclusively for NMP TV and brought to you by our friends at PRMG. They're working for your best interest. We had a volatile week in the markets last week, a lot of volatility, and this was coming on the heels of the Fed's two-day meeting that ended on Wednesday. The Fed came out and did exactly what we expected. They increased the pace of their tapering from $15 billion a month to $30 billion a month. This means that they're more aggressively reducing their purchases of mortgage-backed securities and treasuries. Why does the Fed want to do this? Well, it's twofold. They want to be less stimulative. We're not in emergency-like conditions anymore. They've been injecting a ton of liquidity into the markets. They've racked up a balance sheet of $8.7 trillion, but also they want to get to a position where they can start hiking interest rates. And they've made it clear they don't want to shock the markets and do two things at the same time. They don't want to reduce their purchases and hike rates. But the problem is that hiking rates is the one thing they could do that could really curb this rapidly rising inflation, almost 7% on a year-over-year basis. So the sooner they can be done with their buying, the faster they can taper, the sooner they can start hiking rates. When are they going to hike rates? Well, if theoretically they're done by March, the next meeting after that is March 16th. They'll probably want to wait, see how the market digests this, get a little bit more data, see how the different variants of COVID play out. But the following meeting is May 4th. That's the one I have circled where I believe the Fed might start actually hiking interest rates. How many times are they going to hike? Well, if we look at the Fed's dot plot chart, this shows you where all the Fed members think the federal funds rate is going to be next year, the year following, and in the longer run. And right now, this can change. The consensus is for 3 rate hikes in 2022 and then another 2 to 3 in 2023. So the Fed is definitely moving quicker and getting more serious about hiking rates and actually curbing this rapid inflation that we're seeing. The bond market initially and interestingly moved lower on the heels of this report, on the statement. But then once they digested the news, we actually saw bonds recover. And then in the following days, bonds actually moved a lot higher than they were before the Fed meeting and regained all of those losses. Why? Well, the bond market was smart and said, you know what? If the Fed's going to be curbing inflation and the Fed's more serious about hiking, well, that's actually going to preserve the value of the fixed rate of return you get from longer dated bonds like mortgage-backed securities, which interest rates are based off of. Now, listen, until the Fed actually does this, we still have about 5 months of time where we could still see inflation actually increase. And I do expect that to happen. So you could still see interest rates be pressured higher until May or whenever the Fed actually begins to hike rates. And then you might actually see bonds actually react favorably once they start doing that because it's going to curb inflation. And speaking of inflation, this week, we're getting some important news. The PCE, or Personal Consumption Expenditures Report, is going to be released. This is the Fed's favorite measure of inflation. I don't think it's the best one out there. It runs a little bit lower than some of the other reports out there. None of them are perfect, but this is the one the Fed focuses on. And the last time we saw it, it came out at 5% year over year. And then the core reading, which is really what they focus on because it strips out the volatile food and energy prices, was at 4.1%. I anticipate these numbers to rise. I think the headline is going to go from 5% to 5.5%, and the core number is going to go from 4.1% to 4.5%. We'll see how it plays out, but hotter inflation could certainly cause some turbulence, and bonds typically don't like that. So we'll be watching this for you. But hey, if you haven't come on board with MBS Highway, you're crazy. We break this stuff down for you every single day so you can better educate and inform your customers and really build a lot of trust. Come check us out, mbshighway.com. Thank you guys, and I'll talk to you soon.
PRMG continues to provide our wholesale partners across the nation with better technology, better product, better pricing, and better service. Our nationally recognized brand is more than just an image. It is a symbol of integrity. PRMG, built by originators for originators. Be sure to click on the link below for your free 30-day MBS Highway trial.